Hey everybody, my name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive tech for a broad audience of investors across the globe. Today we're going to talk about the right time to sell Nvidia stock. Now, we need to qualify that by saying we don't tell anybody when to buy or sell a stock. This is in the context of our own position. So we'll start out by looking at an article we published in July of last year, and this was titled, it's rather clickbait, Why We're Selling NVIDIA Shares After the Split. So, the real reason that we were selling NVIDIA shares was that when the stock price around the time of the split was hitting new highs, that stock was exceeding 10% of our overall tech portfolio. So, we have a tech portfolio of stocks, about I think 38 right now we're holding. And Nvidia, because it has performed so well over the years, was exceeding 10%. Now, most portfolio managers will put a rule in place that says if a stock becomes too overweight in a portfolio, then you trim it. And that's what we did. So I just opened our brokerage account and pulled this information out. These are sales that took place for our Nvidia position in 2021. And starting at about 11:05, all of those sales until the end of the year were above $300 a share. So, in the same way that we don't try to time the market when we buy a stock, we don't try to time the market when we sell. So, when we started trimming, the price of that stock kept moving up after the split. That's typical. Most firms experience a gain between the time they announce a split and after the split takes place. So, when we sold these shares, we reduced our position now that it sits around 10%. So that's how high the stock price was going, that no matter how much we trimmed, it kept exceeding 10%. And in looking at our books, it appears that these sales alone, we recovered our cost basis 7 times over. That means the initial amount of money that we put into NVIDIA was returned to us 7 times over, and it's still the largest position in our portfolio. Now, the question that we have today is more of a broader question that says, when we have a large company that we're holding, so NVIDIA is a $600 billion company, that's quite large. When does that become mature enough so that we no longer look at it as a disruptive tech stock and more as a company that's just doing its business? So, when would we ever consider selling Nvidia? So, not just trimming shares to keep our weighting down, but when would we sell the stock? And this chart that I put up here, we put this together. This is kind of how we look at investing in disruptive tech stocks. So, in medium and large, that's our sweet spot. And ideally, that's where you'll invest in a company and they'll eventually become a mega cap. And then you'll trim and use that money to invest in other medium and large companies. And this cycle continues. So, this is kind of a methodology we use. Along the bottom, you can see our target weightings, right? We don't want to have a lot of our investments in small stocks because they're quite risky. Our sweet spot is really large, between 10 and $100 billion. And we particularly like business models like software as a service. We don't invest pre-revenue, and you can read all about that in our methodology. But the question is, right now we're holding two mega caps. Nvidia is one of them. When would we ever consider selling them? Well, when would you ever consider selling a stock? And for us, we look at two things. Did our thesis change, and has growth stopped? And the growth stopping gets a bit tricky because, for example, prior to coronavirus, you may have had a company that had a year where growth had stalled, and then you had the pandemic. So now they have 2 years where growth has stalled. So then you're hoping that the following year the growth resumes. So it becomes quite tricky to tell when growth stops. Now, for NVIDIA, we can clearly see growth is on a steady trajectory upwards. On the left-hand side, you can see the annual growth. You see their dip in 2020 due to the Rona, and then you see things take off. That boost in 2022 is from their acquisition of Mellanox. And you can see on the right-hand side here that quarterly revenues continue to grow. There's certainly no problem with revenue growth for NVIDIA. So that wouldn't be, there's no reason to sell the stock because they continue to experience growth. Now, what you want to look at next is the catalysts for future growth. So This is where we check up on our thesis. So, three things we're going to look at today: our original AI chip thesis, the failed ARM acquisition, and competitive pressures from companies like ARM. Now, when we look at AI chips, that was our original reason for investing in Nvidia. And today that they're referring to that as the data center revenue segment, and that now accounts for 46% of the revenues. Here you can see that nice, strong growth. Now, they use fiscal years. Who knows why they do this stuff? It's very confusing, but they use a fiscal year. So, for all practical purposes, don't pay attention to the labels. The 5 year compound annual growth rate for the data center segment is 66%. That's excellent. Hopefully, they can keep that up. Now, one problem that was announced this last month, let's see, it was in February, so we're already in March, and the ARM acquisition fell through. So, what does this mean? Well, when you go to acquire a big company, you spend a lot of time and energy on the acquisition. So they wasted all that focus. They spent $1.3 billion for nothing. So that's what they lost as a result of the deal falling through. It fell through because of regulatory reasons. There's nothing they could do about it. Though one could argue maybe they should have been able to forecast there would have been problems there. So now they have to go back to the drawing board and figure out, all right, where else can they look for acquisitive growth with the $10 billion net they have on their books? Now, one thing that's upsetting about the ARM acquisition, we were particularly excited about that. So back in 2017, we wrote an article, and we'll put a link to it in the description, on Masayoshi Son, the CEO and founder of SoftBank, talking about why he acquired ARM. It's a spectacular presentation, and we wrote an entire article just around it. And his thesis was that IoT sensors will be producing all the big data that AI algorithms use to learn and to create efficiencies, and that ARM is expected to ship, this is what he said in 2017, over 1 trillion IoT chips in the next 20 years, commanding an 80% market share. So you talk about, AI chips. Well, what is an AI chip? Would this be considered AI chips? Well, you may say they're IoT chips, but you can see from this diagram how everything comes together. So we were particularly excited about NVIDIA acquiring ARM. Well, when NVIDIA's deal fell through, another company was moving forward with an acquisition that was completed successfully. That company is AMD. And back in 2017, we looked at how AMD and NVIDIA compared in terms of both companies producing GPUs and how they would be used for artificial intelligence. Now, this becomes complicated to compare the two companies. So, for example, NVIDIA, when it comes to their gaming graphics cards for PCs, has more than 3 times the market share that AMD does. So you need to start breaking things down by segment and looking at how the two companies compare. Well, if you look at their investor decks today, they're looking a whole lot similar. And following AMD's acquisition of Xilinx, they're now more able to compete in the data center realm. And we wrote about that back in 2017, how Xilinx, their FPGAs, those were being used for data centers. So when we look at AMD and NVIDIA today, both companies are doing very similar things. So one of the things we can do is say, how are they valued comparatively? Well, we use our simple valuation ratio, and we see that NVIDIA is significantly overvalued compared to ARM. So our simple valuation ratio takes market cap and divides it by annualized revenues. Now, you say, well, maybe that's because NVIDIA is growing faster. They're not. This chart here shows growth over the past 12 quarters, and both of these companies are growing at a compound annual growth rate of about 11%. So that's certainly not the reason. The reason may very well be that cash is king, especially today, as investors start to sour on growth and look for companies that generate cash. NVIDIA is clearly leading AMD in that respect. This shows the quarterly profits for both companies over the past 12 quarters. So there's certainly a reason, if you're risk averse and worried about future worried more about future growth than you are about companies that can generate cash today, then Nvidia's certainly, it gives you the best of both worlds. They're able to grow their business so far quite well, and they're generating a lot of cash. So, and just to conclude, NVIDIA is still our largest holding, around 10%. We recovered 7 times our cost basis in 2021, but we need to be careful about the house money effect. And that says, all right, maybe our NVIDIA position today is completely playing with the house's money. Well, when you start playing with the house's money, you start taking more risks than you would the whole weekend millionaire thing. So we want to be careful about that and really pay attention to Nvidia's ability to continue that growth. And we're particularly interested to see what plans they have for filling the arm gap, given that the acquisition has fallen through. So thanks so much for your time. Please post your comments in the comment section of the YouTube video. Make sure to subscribe, and we'll be putting out more videos on similar topics. So thanks again for your time.